Hey everybody, in this video I'm going to be diving into the actual spreadsheet that I created when I was deciding whether it was feasible or possible for me to leave my corporate job and dive into self-employed entrepreneurship full-time. So in this video, let's dive in. I'm going to show you how I went about calculating all these things and answering these big questions, and hopefully the file can work for you as well. That being said, guys, let's just dive right into this file. And the first thing I want to say about it is that anywhere in this file where you see anything that's highlighted in yellow, like this area in particular, you're going to have to manually put in these values. Anywhere where you see numbers that don't have yellow highlights, these are going to be formula driven. Okay, so these are your hard-coded inputs in yellow and formulas everywhere else. Now, let's just briefly talk about what this file is doing. So really, we're going to have a revenue estimate. Then we're going to figure out, what you're making for the whole year or each month based on all of your different various income sources. Then we're going to go down and figure out all of the monthly expenses or annual expenses and figure out how much are your business expenses each month and each year. And then we'll basically come up with this sort of earnings before interest and taxes in some way for your business. And then we can start to look at things that you as a self-employed individual or entrepreneur can get tax deductions for. For example, if you have a home office, you can write off part of your house, a certain percentage based on the square feet to try to reduce your taxable income. So we'll figure out how you can reduce your taxable income, and then we'll figure out, based on that reduced income, what is your self-employment tax? How much do you need to be paying to the IRS each quarter? So that brings us over to a sheet where I've kind of included the option where you can say whether you're filing single or married, and then estimate your taxes and how much you need to pay each quarter. We'll get into more detail of how that works. And then we'll account for things that reduce your taxable income on a federal basis, right? Like if you contribute to a self-employed IRA, HSA, stuff like this, or other things that might increase your income that are not specific business sources of income, to basically adjust what we already have to figure out, hey, what are your federal income taxes based on your actual total income. So I've got a sheet over here for that. For that, we'll use single or married and all the different tax brackets and figuring out how much you're going to pay in total. And then after we have all that, we're going to basically find like, hey, what's our monthly net income and our annual net income after we've paid all our taxes. And then this is where I get into putting in things related to your actual budget, like in it with a monthly estimate, and we get an annual estimate. And then we kind of figure out, based on our net income after everything we took out, deductions, taxes, self-employed IRA, HSA, all that stuff, do we have enough to cover our monthly expenses? This is really the big question to answer, like, hey, are you ready to dive into entrepreneurship or self-employment full-time? Or is now maybe not the right time for you because you're not making enough to cover all the things that are required to pay? And so if your personal expenses are lower than the net income after taxes and self-employed IRA, HSA, all that stuff, you're going to see a positive value in your business and profit and loss less your personal expenses. And if you see a positive value here, this could be a good indication that your business or your forecasted business might be enough to cover everything that you really need. Or if you're already in business, just figuring out, hey, how much do I basically make after I pay everything each month, including all my bills? And then this is where I get into information about what I'm saving. I want to figure out how much am I saving in the Roth IRA, how much am I saving in my bank account. The bank account is basically a plug for everything that's left over from here after we contribute to other savings accounts. And then also how much did we contribute to our self-employed IRA, our HSA, etc. And we come up with sort of a total savings estimate for the whole year. And then based on this total savings, we're also going to have our personal balance sheet, all our biggest assets, all our biggest liabilities. Our net worth will be all our big assets minus all our big liabilities. And we'll come up with, expected interest rates for each of those and the interest rates for our liabilities to come up with a total interest rate, a total net worth. And then once we have all that information, plus we know how much we're saving each month, we can start to do this estimate where we're going to try to figure out our actual net worth, where you can put in, your birth date. So you figure out how old you actually, it figures out how old you actually are. And then we'll put in an inflation rate, an age you want to retire. Then we'll use that net worth from this page over here to factor into this, and also how much you're saving each month based on all these various savings to figure out, hey, if you can actually hit these forecasts and your wages increase at the rate of inflation and your expenses increase at the rate of inflation, and you want to retire by a certain age, how much money are you going to have at that age in terms of today's present value? And is this a feasible lifestyle for you? So really, I just made this whole model to answer all these big life questions, and I hope you guys will enjoy following me through it and maybe it'll answer some questions for you. With that being said, my goal in this video is to go over everything in enough detail that you can follow along from your computer and implement this model exactly the way that it is. Also know that I'm offering this file for sale on my website. So if you want to save yourself some time, you can buy the file from there and then just plug in your numbers. But even if you do purchase the file, I would suggest watching this video so you get a feel for how all these calculations actually work, because some of it can get a little bit complicated. So let's dive in with the actual revenue calculations. And so with the revenue, this entire section here is dedicated to revenue. Now you're going to see we have this section called monthly estimate. For each of your potential income sources or lines of business, you will have one single row. So I have YouTube AdSense, file sales, freelance work, etc. One thing I want to point out is that these are not the real numbers for my business, because I'm too Midwest for that. And if I was putting all my stuff out there, like I make this much, I would get a stern talking to from my mother most likely. So this is all fictional numbers. So you can go one by one for each line of business or income source for you and estimate how much you think it makes monthly. This is great for people who don't currently have a full-time business. Now, if you have a full-time business, one thing that might be better is to actually go every month and track how much you made for each month for that line of business. Now, this will give you a more accurate estimate of how much you make each month. So each of these yellow cells is just a place where I'm putting in the fictional amount that I made off each category. And then this right here is going to sum the amount for the whole month. So in this example, this business made $10,058 in January, then $7,700 in February, etc. So we can then use this formula to take an average of all the months for the whole year. And the great thing about this is that it doesn't include these blank values, so they don't get factored in. So then once we have our average for every single category, we can sum up all of those averages. And I'm using a formula that is average if the value is greater than 0, so that we don't include these months that haven't happened yet in the estimate. So now, by only including the months that have already occurred, we can find out that we've actually made $10,366 US a month. Now, if I want to, I could, instead of doing these estimates, I could make the whole model actually based off of the monthly averages. So instead of having this be yellow cells where I manually input them, I could just actually use the real numbers by setting it equal to that and dragging the formula down. But I'm going to leave it with the estimates actually for now. Another thing is this is the annual estimate, which will just be based on the monthly estimate times 12 months per year. Another helpful tip is that I always include, if there's something I really want to have a line of business for, but I just haven't gotten to it yet and I know I need to, I will keep it in here as zeros because I need that reminder that this is something I need to be doing. So basically here we have our whole model is going to be driven off of this estimated value. So this is more for our own information, but all the calculations in terms of taxes happen based off of this estimated value. Now I also have this average annualized value, which is our real monthly amount that's based off the historical averages over here, times 12 months per year. So I can get a feeling for, hey, how much am I actually estimated to make this year in reality? Now let's dive into our expenses. You have to spend money to make money. So I've found it most convenient to break expenses into two separate sections. And this might be different for your business, but for me, I have a lot of business expenses that are charged monthly, and then I have a lot that are also charged annually. So I have this whole section for monthly charged business expenses where I put in how much I pay per month on each of these different categories. And then the annual value is just that value times 12. So I just use that times 12 formula for all of them. And then now for the business expenses charged annually, I put in the actual annual value that I'm paying for each of these things. And then I will just divide that value by 12 to get the monthly value. And then we can just sum every single monthly value to get the business expenses total for the month, and then multiply that value by 12 to figure out what's our total business expenses annually. So this tells us that we were going to make $10,000 a month in revenue, but we're going to spend $1,150 in expenses. So now we figured out that the amount that we have of our revenue after our expenses for our business is this one, our revenue minus the expenses, gets us to about $8,850 monthly. So this is really a real reflection of our income off of this business. And we can figure out that that's more like $106,000. Now, here's one of the advantages of being a self-employed entrepreneur is that we can actually take advantage of lowering our taxable income by accounting for certain things that the IRS allows us to reduce our taxable income for when we're taking into account our self-employment tax. So if you are not aware, you might realize, or you might not know, but as a self-employed individual, unfortunately, there is this self-employment tax that is about 15.3%. So you should do a good job if you're self-employed about writing stuff off, tracking these business expenses, and then taking whatever deductions you can get, because that is a steep increase in your taxes that you might pay rather than someone who works for someone else. So in this section, I've gone through and I've looked up all the things that I can write off for my business. And then basically you can allocate a percentage of that expense that's applied to the business. So if you have to go buy your own healthcare insurance, you can deduct 100% of that from your self-employment income. For your rent or mortgage, let's say in this example that your rent is $2,000 a month. Now, you can go and measure your home office, find out what percentage of the square feet of your home are based on the square footage of that room compared to the total, and then you can multiply that to figure out how much can you reduce your self-employment income for each month. So we do this for all our categories. Electric bill, we apply 15%. Internet, we apply 50%. And then over here, we can take the total amount multiplied by the percentage for each one, and then apply that formula for all. And then we figure out that we can reduce our business income by $802 for all this personal stuff. And now after that, our business revenue is only $8,000 a month or $96,000 a year. So now that we have that, we can go and figure out what is our self-employment tax. So our self-employment tax is going to be based on our business revenue after all the expenses multiplied by a flat 15.3% each year. And I should mention that this is, US specific and it's not made for other countries. So we figure out here that we really owe about $1,231 a month in self-employment tax. And that, if we multiply it by 12, gives us our annual self-employment tax amount. And that is one thing as a self-employed individual that really stinks, because if you work for someone else, you pay half of this. You basically pay 7.65%, and then your employer pays the other 7.65%. As a self-employed individual, you pay the full amount, unfortunately. Now we can figure out what our real business net income is after we take what our business revenue after expenses was minus those self-employment taxes. Because I don't use this business revenue after all the expenses, because these aren't really true business expenses. We'd be paying these either way. So to me, this is a more accurate sort of understanding of business net income and a more accurate understanding of what is going to be taxed for the federal income tax. So truly, after we take out that self-employment income and all these expenses, we're making about $91,000 a year out of our original $120,000 a year. Now we can keep going based on this number. And this whole category is going to be for stuff that reduces your taxable income, but wouldn't reduce your self-employment taxable income. So let me clarify. There's basically different categories of income. So one is federal, and then one is as a self-employed individual, a tax that you pay specifically. So everything we talked about so far was for the stuff that relates to the self-employment taxes. Now we're going to get into the stuff that impacts your actual federal taxes, your federal income taxes. So if you have a self-employed IRA that you contribute to, that will reduce your taxable income for the federal taxable income, but not the self-employment taxable income. Same with an HSA, that helps reduce your federal income taxes, but not your self-employment income taxes. Make sense? So this category is for everything like that. And there's some other things that could be included, like perhaps like interest income you earn from your bank or investments and stuff like that, or potentially like if you cap gains on stocks that you made profits on and then sold, or maybe you have some other work that you do that's unrelated to this business that should be included into your personal taxes as well. So there's so many other things that you could probably include here in buckets that I haven't even listed, okay? So now we're going to basically either reduce or increase our income based on all these other things. So in this example, this person's really just reducing their income because they contribute a lot to things that reduce their taxable income, like self-employed IRAs and HSAs and such. So then we figure out that basically we can reduce this income by $1,300 a month or $15,600 a year. Now we're going to figure out what is our federal income tax. And so this is based on this tab over here called federal income tax. So these numbers, I should clarify, are for the year 2024. So if you're watching this video in a year that's not 2024, you should update or use different numbers. The file that I'm selling on my website will always have the most updated numbers. Now, if you're wondering where to find updated numbers, I'll pull it up right now. So how I would suggest updating these numbers is you can go to Google and look up IRS federal income tax brackets, or you could look specifically for the year that you're interested in. So for me right now, it's 2024. So I'll do 2024 and I'll see this IRS government link. I'll click that one. So here is, this right here is 2023 for single taxpayers. And then if I scroll down, I have married, filing separately, filing jointly. So there's the married one. And then basically you just need to figure out what is the IRS saying are these tax brackets for each year. Now you'll see that from a rate of 10% is taxed for income between $0 and $11,000, right? And then from income from $11,000 to $44,000, it's taxed at 12%. So I'm going to walk you through all this logic right here. So basically, we are going to punch in our upper bounds for each category, right? So we're going based on 11,600, then 47,150, etc. And so I just punched in all those values the way they are. Now, the lower bound for the first bucket is always 0, and then the lower bound for the next bucket is always equal to the upper bound of the previous bucket, right? So we can set that equal, and then we just drag that formula down for all of them. I just capped this at 100 billion, so unfortunately there's going to be like 3 people in the world that can't use this spreadsheet. Maybe I'll throw one more 0 on there. In case Elon wants to use this spreadsheet, he can have a go at it. There we go. Okay, and so then married, you'll notice married slightly different for the upper bounds of each one. That's because married people can make more, basically have less, they basically get a tax benefit of being married. So now let's look at how we're calculating our taxes in each category. So here I'm doing this little calculation where I have my total business net income, which comes over here from D51. D51 is the business revenue after all expenses before we actually reduce our business net income for that self-employment tax. So unfortunately, you can't reduce that federal income tax by the amount you paid for the self-employment tax. However, you do get to reduce it for all this personal stuff that you included. So we have this 96,000 here, that's our D51. We go back over here. Now we can take a total non-business income adjustment, which is going to be from D63. So if we go over to D63, we see that that is the amount that we had for all these things like the self-employed IRA, the HSA, all that stuff I talked about. Potential other incomes would actually increase this amount. So in this example, we're reducing it by that much. And we figure out this total taxable income is about $81,000 for your federal income taxes, those personal federal income taxes. Now we can apply a standard deduction. So this standard deduction is actually, you might change based on the year 2. So when you're going through this process, if you're not in the 2024, you might want to go Google the current year you're in and do standard deduction for this year. So this is basically going to reduce your taxable income by this amount. Then we can actually reduce our taxable income by half of the self-employment tax. So remember before I said we can't, reduce it by the total self-employment tax, but we can take this value here, that $14,773 we're going to pay in self-employment tax, and then divide that value by 2 to find half of it, because it's like the half that the employer would have paid had we worked for someone else. So now we can reduce our total taxable income by the sum of both of those values to get this total taxable federal income of $58,971. So now we know this is the amount we're going to use for, right, what's our total taxable income. Now we go into these buckets. So we're going to be saying, hey, if this value here is greater than the upper bound of this, then we use the total upper bound of that bucket, and we incur we're going to incur the 10% tax on it eventually. But if it's not above that, then we'll just use that total taxable income there. And so we figured out that we're going to have, of this 58,971, 11,600 of it is going to fall into this bucket, and it's going to be taxed at 10%. Now we get into the next bucket, which is going to be a slightly more complicated formula where basically we're trying to figure out how much falls into this bucket. So it's going to be if D24, so if this value is less than this lower bound, this 11,600, then there's really going to be nothing in this bucket at all. So that would be 0 if that condition is true. However, if this is greater than C6, so if this value is higher than that value, then this entire bucket's going to be filled. So we can just take the total sum of this range. For this one is that 35 grand or so, right? Because we're exceeding the whole range. Whereas if that's not true, then that means that this value is going to fall somewhere between these two numbers. So we need to take this number minus the lower bound. So we figure out, we fill up the whole range with this amount of income, and we're going to have this much income that falls into this tax bracket, and our tax in that category is going to be equal to the 12% multiplied by the income that falls in this category. Now, beyond this point, you can literally just drag all these formulas down, and that will be a consistent formula that you can use because it's going to find the total amount that falls into each bucket. So now we get to here, only $11,000 really exceeds the lower bound. So then there's only $11,000 in this bucket that's getting taxed at 22%. So now we figured out basically our total tax for all the different buckets, right? And if we were married, we'd be using these higher upper bounds, which would have the effect of reducing our overall taxes. So if we go back over here into income and expenses, this is going to depend on if we're married or single. And so we have this, sorry, I'm looking down here. This is going to depend on if we're married or single. So I have this formula over here that's going to get a little bit more complicated. So basically, I'm using this value here. So I've created a little checklist, which you can create this on your Excel file too. That's a single or married. I'll show you how I created this. So let's say if I wanted to create this list right here, I can go up to data, and then I can go up to data validation, then I'll do a list, and then I'll do single, comma, married, and hit OK. So now there's a little arrow that pops up. I can click single or married. So let's say in this one I'm single, whatever. So that's the same thing I did here. So now we're going to point this formula over here at that quarterly taxes owed. So we're saying if this value right here is single, then we're going to go over to the federal income tax and sum G5 to G11. Now, if we go over to federal income tax and sum G5 to G11, we figure out that this is the total amount we would pay in our federal income taxes as a single person, which is this $8,026 we see right over here. Whereas if we change it to married, that should reduce our taxable expenses. So if we change it to married, then we see that this value is actually only the $6,636 that would sum from federal income taxes N5 through N11, which is all those married brackets right here. We have estimated our federal income taxes. Now the next important item to consider is state income tax. Now certain states have no state income tax. I have the benefit of living in Texas, which doesn't have state income tax, so I can just put 0 in there. But you might live in a state with state income tax. So the way that you can quickly estimate this is we would think about this amount that was our total income after all those total non-business income adjustments. So our $80,958 approximately. Then we can go to Google and put in whatever our state is. So I'm typing in Illinois State Income Tax Calculator. And then I'm going to put in that $80,958. I'll just type my location in here. So this smart asset, I've tested it for a number of different states, populates it has a different calculator for pretty much all the states that I saw. So we're going to grab Springfield, Illinois. We're going to click whether we're single or married, and then it'll give us a value. So let's say in this case, we would just plug in this 3,887 straight into this cell here for our state income taxes, and then this would be just that value divided by 12, and that would serve to reduce our net income after taxes, self-employed IRA, HSA, all those various other incomes, etc. And then we find that really at the end of the month, we've got $5,440 to either pay our bills or to put into our savings or our bank account, etc. So I'm going to change this back to 0 for people who don't have state income taxes. And now this is where you really just go in and think about every single monthly expense you have. right? So this is going to be you sort of budgeting all your things. One thing I did was I highlighted tan all the things that I was going to reduce my my actual personal expenses for up here. Everything else is just purely personal expenses. Figure out a rough amount that you spend each month on personal expenses. Then you can multiply that value by 12. So all of these are, I should actually highlight all these yellow if we're sticking with the convention of the file. Let me highlight all these are yellow values that I just punched in myself. Then all of these are just multiplying those monthly values by 12 to find an annual estimate. So now we have our personal expenses for the month, which is just a sum of all of those values. And we have our estimated annual value, which is that times 12. And then we can figure out what's our, our business P&L, basically this net income, I should say, less all the personal expenses, which is this value here, subtracted by all the personal expenses. So in this case, we're basically going to be able to save about $1,400 each month. So this is a big answer to the question of if you're ready for entrepreneurship, or if you're in entrepreneurship, how profitable are you after you have to pay for all your personal stuff. And then once we get down to these post-tax savings, I'm basically punching into my Roth IRA the amount that I have saved annually in that. So right now the max is $7,000. So you can figure out how much you're contributing each month, and that factors in here. Now, if we go look up back up here, one thing I want to clarify is that, never mind. Forget what I was saying. So we save this much a month, and we save this much a year, and then we put this much in the Roth IRA. So that means that we're going to basically have a plug number. So we have this $14,000 of savings each year. Each month we put $583 of it into our Roth IRA, which means we're basically going to have $850 left that we can put into our bank account. And I put this note up here that this is basically a plug. So then if we multiply that value by 12, we figure out how much we're saving in our bank account each year. And then we figure out how much we're saving total in these post-tax savings by summing those values above, or how much we're saving in our post-tax savings each month. And then we can figure out how much are we saving pre-tax, which is going to be based on the values from up above. So in our SEP IRA, we're just taking this value from 58, C58 right here, and turning it positive. The HSA, we're taking this value from C59 right here, and we're making it positive by putting a negative in front of it. Right, so now we figure out how much we save on both of those annually by multiplying both of them by 12. And then we can just sum those values up to figure out how much we're saving in our self-employed IRA and our HSA each year. And also, for each month, we sum those up. And then we can figure out our total savings pre and post-tax are $2,700 a month. And our total savings pre and post-tax are about $33,000 a year. Now that we've got our total savings pre and post-tax, there's something else I wanted to really briefly talk about. It's the personal balance sheet that I've created here, where you can go and plug in all of your biggest assets and your biggest liabilities. So let's say in this hypothetical, the person has a Roth IRA with a value of $100,000. They're expecting it to increase at about $7,000 per year, which tracks roughly with the average of the S&P 500 index each year. So these are going to be things where you can look up, hey, how much does the stock market typically return, or a bond market, or whatever you've got in there to come up with your estimates. And then this value is going to be based on the total value multiplied by the expected interest rate. So for this one, we're expecting to earn $7,000 of annual interest this year. Now, we can take all these different categories and apply the expected interest to all of them. One thing I want to highlight here is that I have, let's say this person hypothetically has a home that with a value of $400K, but they also have a mortgage on that of $300K. So really they have 100,000 of home equity. Well, that's going to be accounted for in this calculation because here we're going to sum all the total assets. So the total assets is $775,000. Whereas down here we're going to sum all the total liabilities, which includes that mortgage, so it's $320,000. So then when we subtract to find our net worth, our assets minus our liabilities, we're including that 400K minus the 300K to really come up with, in this net worth is 100K value of home equity. All right, so now we do the same thing with our, let's say the mortgage pays 6%, there's some car that pays 7%, a car loan basically. And then now we're going to figure out, hey, what's our, the sum of the annual interest paid on the liabilities. Also, one thing I should say is that we can calculate our total expected interest earned on both categories by taking that, that annual interest earned or paid divided by the total amount. Same thing for the liabilities. And then we can also find that for the net worth. And now that we have our whole personal balance sheet, we can go calculate our net worth over the course of our working life and figure out how much we're going to have when we retire. Now we know our net worth approximately, and we also know how much we're expecting to save each month. So we can go to this sheet now, net worth calculator, and we'll go to the year column over here, and you can follow this formula exactly if you're following along at home. Basically, the logic is if we're less than halfway through the year, we use the current year. If we're more than halfway through the year, we'll use the next year. And that's what this formula does, so make sure you follow that. Then you're going to put in your actual birth date right here in yellow, and this age is going to be based on that birth date, so you can use this formula right here to figure out the birth date based on the year and the actual age based on the birth date and the year. And then we can also put in the inflation rate of 2%. So this is the long-term Fed target. So we need to basically scale our expected amount we're going to put into our portfolio each year based on the inflation rate. And also we're going to discount our total retirement value by this amount to see how much do we have in today's terms. So I would suggest that you could just use the 2%, which is the Fed's long-term target. You're going to put in what age you're hoping or is your goal to retire at. And then we'll have our starting value, which is equal to that value from our net worth or our personal balance sheet page right here, 455,000. Then we'll have a weighted average of the interest rates, which is going to be from our personal balance sheet as well, that 4.88%. And now we're going to use all that to figure out, hey, what's our net worth expected to be each year? So we're just going to assume our current net worth is what we expect our net worth to be at the start of next year. And then our net worth, the interest on it is going to be equal to that net worth multiplied by that weighted average interest rate. So we're expecting to earn an interest of $22,200. Also, the contributions to investments is going to be the amount that we have right here. So this $33,310. So one thing to just clarify is I'm not specifying between pre-tax and post-tax assets. If you want to make an even more thorough model, you could even account for the pre-tax and post-tax. That gets really complicated, and it was going to make this file way too big and this video way too long. So I'm just putting everything in one bucket, which makes it a little less accurate. But I didn't want to make this overly complicated this time. So then for the next year, we're going to have a formula that's basically going to look at the previous year and improve it by 1, or basically increase it by 1 if it doesn't match either of these conditions. So it's if, and then we have or. There's two conditions that if these happen, we will no longer continue this table. One is that if C3, the age, is equal to the retirement age, so the age from the previous row equals the retirement age, then we know that our table just needs to stop, right? That's why this table just stops at 65, because that's when we want to retire. Or if this value in the age column is just blank, then we'll also just, if either of those are true, we're just going to do blank because we want the whole table to stop after we turn 65. Now, the age one is just going to be last year's age plus 1, and it's going to be based on this if statement that is also looking at, hey, if last year was the 65 year, we'll just stop the table at that point. All of those are going to be based on the exact same or statement to stop the table at that point. So now this value for the net worth at the start of the next year is going to be equal to the net worth from the start of the previous year plus the net worth interest that we made last year plus the amount that we're contributing that year, or contributing last year, right? So our net worth was $455,000 at the start of 2025. We're expecting the net worth to be $510,000 the previous year based on our accumulated interest and our new contributions. Now, the net worth interest this year is just going to be based on this same formula to basically stop the table if we hit our retirement age. Or if that doesn't happen, then we'll take the net worth at the start of the year multiplied by that weighted average interest rate. And then our contributions to our investment account is also, we're going to just stop if we get past 65 with this condition. And then if we're still below 65 or at 65, we can do the contributions from last year times 1 plus the inflation rate. So we're scaling this each contribution in this table by the inflation rate, right? Because likely as you go through your career, the inflation is going to increase, which also your amount you're saving each year should increase as inflation increases. So these contributions scale with inflation, and then we find at the very end, we get a total at age 65, this net worth value. I'm gonna freeze these so that we can see it down there. So we can see our net worth down here is $5,874,000. Okay, so that is going to be in the year 2059 though. So I want to know, hey, my retirement nest egg, what would that really be like in today's value? Because I don't really know what 5.8 million is like in 2059. So if I assume this 2% inflation rate, I basically am using this formula where we're going to look up to find the last value in column D, right? So we want to find the absolute last value in column D. So you can use the formula just how I put it right here. And then we're also, so this right here gives us the last formula in column D, this one right here. So that returns us the 5 million, you can see it even here, it's really small, but you can see that 5,874,000. Now this one right here is going to we're going to bring it back to today's value. So we need to divide by 1 plus our inflation rate, which is that I4, and how many years do we need to scale the inflation rate by? Well, however many years in the future that value is. So we need to find the last value before a blank, which is what we're doing with this formula. So this formula will tell us the last year before a blank. Now it's really small, but that's the year 2059. See, 2059. And then we'll subtract B3, which is the current year. So that tells us that this happens basically, let's see, how many years in the future is that? 34 years in the future. So we need to discount it back 34 years to a present value of today at an inflation rate of 2%. So really our 5.8 million in the future is going to be 3 million today. And hey, that might be a comfortable amount to retire with if you were retiring at 65 today with $3 million. And then finally, to figure out how much we're going to owe quarterly to the IRS, we can go to this quarterly taxes owed tab. And the way that this is going to be created is I'm just assuming that basically this quarter tax deadlines is the same each year, which I believe it stays the same. And you could change these if it updates. But basically, we're trying to figure out, hey, how much do we need to pay each quarter? Now, I've included some notes here about how you can just divide your expected income by 4 and pay equal payments quarterly. So that's the methodology that I've built into this spreadsheet. There is also an alternative where you figure out how much you made each quarter and you pay based on that quarter, but I'm keeping it simpler with this estimate. So the way I'm doing it is I'm going by income and expenses D54, which is right over here, which is our self-employment taxes annually. And then I'm going to divide that value by 4. So this is our total. If we sum all these up, this 14,773 is how much we need to pay in self-employment tax total. We divide it into 4 categories and pay each quarterly. Then for federal, that's going to be income and expenses D66, which should be our annual federal income taxes of $6,636. And then we divide that by 4, so we split it into 4 equal buckets. Then we'll add the 2 together. And then we're figuring out that based on everything we've seen in this document, we basically need to be sending about $5,300 to the IRS every single quarter as a self-employed individual. Thank you so much for sticking with me all the way to the end of this video if you made it here. I want to treat this as a document or a useful resource for everyone that they can use in the future. So I'll make updates to this file on my website if anyone finds any errors or mistakes. And if you found anything that might not be right, I'm only human, I do a lot of research, but please put in the comments anything that you think maybe could have been done better, or estimated better, and then I'll keep a pinned comment at the top of this video for if anyone can come up with better improvements. I'll keep basically updating if there's anything that should be done differently. So if you're watching this video now, go check the pinned comment to see if there's anything that I did in the video. I'll include timestamps where perhaps it could have been done better if anyone figures out. With things like this, it's really complicated, so it's possible to have human error, and I'll rely on you guys to potentially help out with spotting those. Anyways, thank you for watching this video, and subscribe for more just like it.